Okay, about myself, a quick introduction. Basically, I am the Wealth Advisory Director and also REIT specialist of Singapore largest independent financial advisory firm. At the same time, I'm also the SGX trainer, educating investor on the REITs and also introduce REIT to the overseas investor and also brokerage firm. Every month, I will be on the Money FM 89.3 to give the market outlook. So if you want to have a close follow up with the Singapore REIT market, how the REIT market is performing, you can just search for the Money FM 89.3 podcast every month. Okay, so before I start, I just want to let everyone know that recently, a few days ago, actually there are scam on the Telegram, or maybe moving forward, you'll be on a Facebook or other social media on those investment packages I'm offering. So I just want to alert everyone, those are scam. Those are scam because I don't offer any investment advice, especially on a paid advice on any social media, because I am the licensed financial advisor. Basically, before I offering any financial advice, definitely I need to talk to you. I need to know you are the real person, understand your financial objective before I can give any recommendation. So if you do not have those, if I don't speak to you directly or at least have the video conference and those things, and you do not know who are the people behind, do not transfer the money or do not sign up any package. Those are scam. All right. So the scam is pretty real. They're even using the SGX logo in their infographic, and people treat it as actually these are the legitimate SGX causes or investment advice. No, those are scam. I keep repeating. All right. So do not fall into the scam. Protect yourself. So disclaimer first, all the presentation I present today, they are just for education purpose. Although I am the licensed financial advisor, but not all the information I share here is really suitable to you. All the information I share here basically just for public information or for general education purpose. If you need any specific advice to your personal situation or your personal financial objective, you can talk to me separately. Okay, so these are the today agenda. Okay, basically we'll review the first half of 2024 performance. Then after that, I will be sharing about 2024, what would be the US interest rate outlook and what would be the interest rate impact on some of the financial ratio. Then I'll follow up with the overview of S-REIT sector in Singapore in general. And lastly, I will give you a summary, what would be the key takeaways and also investing strategy on the Singapore REITs. So review of the first half of the year. Okay, if you look at this chart itself, 2024 is over here. Okay, 2024 is over here. You can see from here that basically the REIT index actually started high. Later, I will explain why it started high. Actually, last quarter, have a rally and reach a new high beginning of the year. Then since then, actually, there is a huge correction for Singapore REIT. All right, so Singapore REIT for the first half of the year is negative compared to the STI, Straits Time Index, and also the financial index. Basically, for the first half of the year, the whole STI was powered by the bank sector. If you have invested in DBS, OCBC, UOB, probably you have seen a very good gain. But if you're invested in REITs itself, you probably have been seeing the negative return. It depends on when is your entry point. Okay, but at the present moment, if you look at the chart for the past 3 or 4 years, okay, this is the FTSE ST REIT index represent the whole Singaporean sector. And from here, actually back to March 2020, which was during the COVID crash. During the COVID crash, actually the REIT index plunged by close to 40%. Then after that, have a V-shaped recovery, rebound very strongly. Now, at the present moment, we are trading close to the COVID level, okay, in terms of share price, in terms of the index, okay. And also recently, the REIT index has been forming a base here. You can see that actually there's a support line over here. Whenever it hit a support line, it rebound. When it hit a support line, rebound, okay. So in short, in short, at the present moment, the REIT index actually is moving sideways. Looks like finding the bottom and waiting for the next catalyst to determine what will be the next direction moving forward. Okay. So in short, year to date, 2024, the FTSE ST index dropped by minus 9.4%. And during the COVID period, FTSE index have a minus 32% compared to the pre-COVID. Okay, so current level is trading close to the COVID crash level and forming a base with a strong support. So this is a summary on what is currently the FTSE ST index is doing now. Okay, so I will show you on the 10 years US government bond yield, what causes the rally last year, Q4, and also what happened to this year, why the REIT has been performing very badly, right? This is the US 10 years government bond yield. Last year, you can see that actually when the US 10 years risk-free rate peaked at 4.9%, then after that, immediately have a plunge to below the 4%. Actually, these plunges in the treasury yield causes the REIT to be rally because of the inverse relationship of the S-REIT index. And after that, beginning of this year, the US 10 years government bond yield actually trading on the uptrend. That's why you can see that it's S-REIT coming up. When the US Treasury bill, 10 years bill coming up, the S-REIT actually go through correction. Now, what has changed since May? At the present moment, the US 10 years US government bond yield currently is trading on downtrend. You can see very clearly it's a downtrend. So actually, this give the REIT investor and the REIT sector a slight hope that maybe REIT is due for a bullish turnaround. Okay, and this is a overlay chart compare the US 10 years yield, government bond yield, and also the S-REIT index. Okay, it's a little bit busy. You just follow me in this way. Okay, so the candlestick represent basically the FTSE ST REIT index. Okay, this candlestick, you coming down, going up, coming down, and also now recently just have a strong rebound recently. Okay, this is the FTSE ST REIT index. And on the blue line, this is the 10 years US government bond yield. And you can see clearly that there is a strong inverse correlation. When the FTSE ST REIT index coming down, actually the US 10-year government bond is actually going up, right? And so on and so forth. Now, at the present moment, the US 10-year bill is coming down. That's the reason why there is a recently there is a sudden spike in the REIT index. And if this trend continue to come down for the US 10 years bill, and most likely the Singapore REIT index probably you have a breakout and also turn into the bullish territory. So for investor, if you need to have some leading indicator, you probably need to look at the 10 years US government bond yield direction. That will give you some sense what would be the REIT index moving forward. Okay, so in short, currently the US risk-free rate is on a downtrend. Okay, this is a clear downtrend. How low can it go is very much depends on the how much the interest rate is going to cut. And first half 2024, basically all the sector, all the REIT, basically they have a negative performance. So the only BSG retail REIT record 5.38% gain. Okay, but just to take note that BSG retail REITs, they are not liquid. So this number does not mean anything, right? The rest of the REIT, okay, ECWA actually was suspended. Also, this one does not mean anything, right? If you compare to every REIT in Singapore, listed one, okay, basically they are registered negative return for the first half of the year. Okay, so Cromwell less impacted, followed by Cecil REIT. The most impacted would be more on those US REIT. For example, Keppel Pacific Oak REIT minus 64%, Prime US REIT minus 52%. Okay, but recently there was a strong rebound on the Keppel Pacific Oak REIT and also Prime US REIT because they are able to really refinance their debt that actually give the market some hope that actually the US commercial office may be recovering and the fundamental of these two REIT may not be so bad. That's why they are able to really get the refinance package from the bank. So what would be the second half US interest rate direction? This is the latest dot plot by the FOMC. Okay, so 2024, more or less, we are expecting 25 basis point. At the present moment, it's 5.5%. So we are expecting 25 basis point cut, which means that probably you drop to 5.25%. It's just a little bit cut only. All right, this is based on dot plot. Okay, but moving into 2025, they are expecting majority of the committee member expecting the rate would be reaching around 4%. Okay, which is quite drastic. Compare this year and maybe next year, you'll be more than 100 basis point cut or even 150 basis point cut. Okay, and 2026 onwards, you even come lower. So in general, the interest rate direction will be coming down eventually, and it may be 100 to 100 basis point cut per year over the long term. But when it's going to happen is very much depends on the economic data like inflation data and the unemployment rate from the US. So this is the 30 days Fed futures based on the meeting probability. Based on this probability itself, okay, end of the month, there will be a FOMC meeting. The expectation is there will not be any rate cut because you can see that 97.42% probability will stay at this level. All right, there's only 2.58%. It's quite negligible. You have a 25 basis point cut. But when it comes to Q3, the story and the picture is quite different. Q3, that means September 18th, the market is expecting close to 97% probability the rate will be cut. Okay, so now the REIT index basically is just planning for this rate cut. And I also understand from some of the fund manager itself, the fund manager is still waiting for this rate cut before they start to deploy into the REIT sector. So everybody just wait and see, but they have already prepared for it. So I would expect for the next 1 or 2 months, unlikely we will see the big movement on the S-REIT sector itself, unless there will be a surprises from all the earnings, because earnings has already started. Unless all the REIT, all the sector, they are seeing a strong growth in terms of DPU, unlikely we will see the big movement. So we still have to wait for the confirmation of rate cut, right? So if you look at the probability by the end of year, December 18, okay, it's quite sure there will be a rate cut. If you look at it, 5 to 5.5% basically is 0%. Okay, 0%. And they are expecting 50%, 50 basis point rate cut. Okay, this is the market expectation, right? So in short, if this play out according to this CME probability, there will be 50%, 50 basis point cut, okay, which is a 0.5% interest rate cut to between 4.75% to 5% by end of the year. Okay, then when you move to 2025, you can see that it's pretty aggressive. Every month, okay, in January itself, it'll be 90%, another 25 basis point. March will be another 25 basis point. And also when it comes to next year, June, Q2 or Q3, basically is from the current level drop to this level. Okay, so this would be the interest rate direction. Okay, so definitely there will be a rate cut, but it very much depends on the probability itself. All right, in short, is by how much. Okay, the question is only by how much. Okay, so by end of the year, 92.6%, at least 50 basis point cut by end of the year. And next year, Q1, 93.3%, 75 basis point cut compared to the current level. And 91.6% will be 100 basis point interest cut. Okay, what does it mean to the investor for this interest rate cut? Okay, one thing, if you are REIT investor, any rate cut will be beneficial to the REIT itself. Okay, that is one general observation and also anticipation. But on another hand, if you are investor holding a lot of T-bill, holding a lot of SSP, you will face reinvestment risk immediately. Okay, which means that when your T-bill matured, when your T-bill expire, the prevailing interest rate may be lower, then you have to look for some place to park your money. The next question is where to park your money. All right. So you may need to look for some of the fixed income bonds, some of REITs for you to park your money in the next phase. Okay. But the question is when your money returning to your bank account, all right, maybe the market has already rallied, right? Because everyone anticipate interest rates start coming down, the REIT sector you rally. So investor, you have to plan for it, plan for the interest rate direction. Okay, at the present moment, Singapore 1 year treasury bill has already peaked at 4%. And recently, based on the past few tranches, you can see that actually the T-bill, the interest rate is starting to coming down. Okay, it's expected to continue to come down even further, right? So I expect next month, when Singapore Sing bond also will be coming down because US 10 years bill will lead the interest rate direction. Now come back to the business model, all right? Some of you have attended 6 months ago on the market update, right? But I will still go through this business model as a form of revision if you have attended before. If you do not know, your first time learn about this REIT, maybe this is a education material for you. So in short, REIT basically they borrow money from a bank or a creditor and also raise the fund from an investor. Once they get the money, basically they just go out and purchase the real estate property. And the real estate property, after they generate rental income, after paying off all the interest expense and all the miscellaneous expenses running the property itself, the remaining 90% of the taxable income has to be returned to the investor as a dividend payout. Okay, so this is a business model for the REIT. It's very, very easy to understand. It's basically a landlord business. If you are the landlord, you have been investing in the real estate before, you definitely understand this business model. All right. So the key thing here is when the interest rate is low, it's easy for you to borrow the money and also pay service your debt obligation, your mortgage loan and those things, right? When the interest goes up, immediately you have to pay more interest. And if you pay more interest, your income, your dividend, your rental income, you start to reduce. Okay, this is in short, if you are the real estate investor. But for REIT itself, they are much more complicated because there are some of the financial governance and also debt agreement set up by the bank and also creditor. Okay, so I'll go through step by step here. When interest rate goes up, you will have an impact on interest expense. Basically, you'll be paying a higher interest expense to the creditor, to the bank. That will cause your interest coverage ratio to drop. Okay, interest coverage ratio basically is the measurement on what is the ability for you to use your rental income to pay for interest. Of course, the higher the ratio, the better, right? If your interest expense goes up, but the rental you collected remain the same, basically your interest coverage ratio will drop. Okay, but it's also very much depends on the debt maturity profile. When interest rate goes up, if your debt is not going to mature, you will still have a minimum interest rate impact. And when at the same time, based on the property valuation itself, when interest goes up, your cap rate in the measurement, in the valuation model, will goes up as well. That will cause your property valuation to drop, gearing ratio to goes up, and the credit risk will goes up. After your credit risk will goes up, the funding cost will go up. So interest rate, you have a lot of impact on the valuation and also the interest cost funding. And assuming no change in the rental income, basically the operating expenses, lease expiry profile, rental reversion, occupancy rate, there's no change. You have the interest expense, everything just going up, then your DPO will be lower. Once you have an impact on the DPO, which is paying lower distribution, your share price will start to follow, you'll be coming down. Okay. So So that is more on when interest going up, what will happen to the dividend itself. At the end of the day, investor just want to focus on dividend. Okay, dividend drop, and dividend drop, you also have a impact on your property valuation. Property valuation will drop, right? Property valuation will drop, your share price will drop. Okay, this is what happening currently. Okay, now we need to think forward. We need to look forward. When interest rates start to come down, what will happen to all those financial ratio, and what will happen to the balance sheet and also the DPO and also cash flow to the REIT? When interest rate comes down, the interest expense will be coming down. Again, depends on the debt maturity profile. Depends on how fast they can refinance and how fast they can reduce the interest expense. And that will also help in the interest coverage ratio. That means that in terms of cash flow, they'll become more favorable and also better. That will also help in the property valuation. Okay. Now the property value may be going up. Okay, and when it goes up, the gearing ratio will drop. When the REIT has a lower gearing ratio, the credit risk will also improve. Credit risk improve, the funding cost will probably will be reduced. Okay, so these are favorable impact when the interest rate start to come down. Okay, assuming no change again, right? Basically, your DPU you'll be higher. When you are paying more dividend, of course, the investor they want to invest in something which give you more dividend because your interest rate from a T-bill, from an SSB is coming down. So where are you going to invest your money to get a higher dividend? And REIT is able to provide you the higher dividend. Okay, so this is the impact on the interest rate when it going up or coming down. But do take note that it may not happen immediately because there is always a time lag. All right. So when the interest goes up, you need to wait for some time for the debt profile to mature before you can do a refinancing. And also property valuation, normally they have done it once a year. It is not every month. Okay, once a year. You may need to wait for 6 months, wait for 1 year before the property valuation can goes up. So there's always a time lag of the interest impact. So if tomorrow interest rates start to cut, okay, you don't expect for the next 1 or 2 quarters, you can see the huge jump in the dividend. No, it's not going to happen this way. All right. But more normally the share price you move ahead before the actual announcement are being made and also actual performance in the financial statement appear. Okay, now overview of a current Singapore REIT sector. Okay, at the present moment, this is the yield comparison across different yield asset class. Okay, I just want to make it very, very simple. Everything put in the this histogram so that you can see clearly. Now, the Singapore REIT sector, based on the weighted cap, market cap, the average weighted average dividend yield is 6.63%, okay, which is much higher than your full inflation. Because when we come to investing, whatever thing we do, whatever thing we invest our cash itself, bottom line, we need to beat the inflation, right? If you are not owning the car, not investing in the property itself, at least you need to beat your full inflation, right? Otherwise, your purchasing power will be eroded. So if you park a lot of money in the bank saving, of course, it's not really helping you to beat inflation, right? If you park your money into 12-month fixed D, at the present moment, it's 3.2%, but under the POSB, there's a cap. Once you exceed certain so-called fixed D amount, you are not going to enjoy this amount, 3.2%. Okay, if I'm not mistaken, maybe 10K. 1 year T-bill, 5-year T-bill, and also 10-year government bond yield is around 3% to 3.6%. And when interest rates start to come out, all this number you start to drop. Okay, you start to come down. Even the fixed yield start to come down. Singapore saving bond also same thing. They are all correlated. Okay, CPF OA will be 2.5%. CPF SA 4.05%. And if you invest in the STI ETF for the dividend, at the present moment, the dividend is 4.15%. Right. So you can see that there are a lot of opportunity for you to move your money around to really optimize your return. For example, the safe way is if you have a lot of cash in the bank, right? By moving your money into the SSB or 1-year T-bill, immediately you can optimize the return already. And these are the safe instruments. It's backed by Singapore government. Unless the Singapore government go bust, all right? Which I don't think so, because Singapore government, the financial is still pretty strong. So these are the risk-free way of optimizing return. Or you can move to your SA or move to your OA. You have not really meet the requirement yet, meet the cap yet to optimize your return for your retirement. Okay. So if you already have a lot of money in the OA, you want to maintain some liquidity, right? You can use the OA to invest in Singapore REIT because 2.5% and 6.6 something percent immediately can get 4% difference. That will help you to really beat inflation. Because if you're parking all your money under the OA, 2.5%, but inflation is food inflation is 2.8%, immediately you have actually losses your money value. Okay. For those retiree, do take note that when you reach 55 years old, from 2025 onwards, your SA will be closed. Everything after you meet your FRS amount in your retirement account, your SA account will be closed, so you will no longer enjoy the 4.05%. Then whatever remaining in your SA, you'll be moved to your OA. So if this year you are enjoying 4 point something percent from your SA account, next year you only enjoy 2.5%, right? So you have to plan for it. What are you going to do with the cash in the OA? Should you continue to remain there to enjoy the 2.5%, or you look for something to invest, for example, Singapore REIT, to have a higher return, 6.6%. Okay, and at the present moment, CapitaLand Integrated Commercial Trust is still the biggest market, the REIT with the biggest market cap. So those are domestic link REIT. Okay, CapitaLand Integrated Commercial Trust, CapitaLand Ascender REIT, Mapletree Logistic Trust, Mapletree Industrial Trust. Those are domestic link REIT. Okay, so if it's more or less that you also can consider that the risk is relatively lower, it can be trusted, okay, unless you don't trust the Singapore government. Because if this REIT go into trouble and CapitaLand or Mapletree is not able to rescue this REIT, which means that Singapore government or Temasek also got this problem. And if Temasek also got this problem, Singapore government also got problem already. So there are plenty of option for the investor to choose when it comes to the REIT investing. Okay, but of course, some of the REIT they have a overseas exposure. That will be another story. Okay, there are many options. There are total 38 pure REITs in Singapore for the investor to choose. Okay, at the present moment, do take note that the yield represented here, they are lagging yield, right? And quite a number of REIT, they are trading below the book value. Okay, price to book NAV less than one equals to undervalue, more than one equals to overvalue. You can see that actually quite a number of them trading below the book value. And at the same time, they are giving you a quite decent dividend, definitely more than 5%. That's why you can see majority over here. But also do take note that some of the REIT have problem. They have already suspended the dividend. That's why you can see that although their book value is pretty cheap, price to book 0.2, it's pretty cheap, okay, in terms of valuation, but they are not paying any dividend, right? So this is the current situation. But if the whole REIT market recover, and this REIT start to pay dividend again, immediately there will be a shoot up in the share price. Okay, but it's also assuming whether they can survive under the current high interest rate environment. Okay, in general, the gearing ratio is pretty healthy for majority of the REIT. So except three REIT, two REIT has already breached the 50% gearing limit. Okay, due to the portfolio valuation changes because of the high interest rate, higher cap rate used in their valuation, the portfolio value drop a lot. When they drop a lot, their gearing will shoot up. That's why they hit the 50% limit. All right. And one of them also getting close to 50%. Okay. But beside these three, the rest they are still pretty healthy. A majority of them actually lower than the 40%. Okay, and this is the bubble chart for the gearing and interest coverage ratio. Okay, first of all, investor need to look at the REIT with low gearing. All right, so how to read this chart? You want the gearing as low as possible. You do not want the gearing to uh, uh, get close to 45% or get close to 50%. All right, you want to be a gearing as low as possible. You want your interest coverage ratio as high as possible. So these are the REIT based on the current situation under the high interest environment. They are more resilient because they have a high interest coverage ratio, which means that they are able to pay off their interest obligation easily. At the same time, their gearing ratio is not so high. All right. So there are two REITs over here. And the unsecured borrowing cost and cost of debt also important. You can see that some of the REIT, their cost of debt, it can be as high as 9 point something percent. Okay, you just imagine the bank already charge you 9%, but you borrow 9% interest rate and go and buy a property, give you 7% dividend yield. It does not really make sense, right? Rental yield does not make sense. All right. So this some of the REIT here, they have a problem. So we need to look for the REIT which have a very low cost of debt. Okay, some of them have very low cost of debt. They are either have 1% only. They only pay 1% interest rate or 2% of interest rate. Okay. At the same time, they also have uh the very high the unsecured borrowing. Okay, unsecured means that their property is not pledged. It's not pledged to the creditor. If not pledged to the creditor, which means that if they are not able to pay the interest to the creditor or the bank itself, the bank or creditor will not come in and possess your property. Because once they come in the process of property, basically you are not in control, you are not owning the property itself, then the REIT can go bankrupt. So unsecured borrowing in your stock picking also very important under the high interest rate environment. Under the low interest environment, this unsecured borrowing percentage is not so crucial, not so critical. But at the present moment, it is very important. A financial ratio you have to take a look into it. Okay, and the next thing here is how much percent of the fixed rate interest the REIT is currently having, right? Because when interest rates start to drop, if you have a lot of fixed rate, okay, a lot interest or package already locked in at a fixed rate, then you cannot do much, right? For example, if you lock in your interest rate maybe 5%, that means that before the maturity, you have to pay 5%, 5%, 5% every year until it mature. But if the interest rate suddenly drop to 3%, that means that having this kind of fixed rate interest, you are not able to enjoy the immediate drop in interest rate. So a percentage of the fixed rate interest rate is very different. And because of interest rate continue goes up, for the past few years, actually, REIT manager itself try to enter into the higher percentage of fixed rate. That's why you can see a majority of them that either have a 70%, 80%, or 90% of fixed rate. So that when interest continue goes up, they will not be hit by the increasing interest rate. But on another hand, when interest start to come down, if they are not able to enjoy or take advantage of an interest rate environment, they are not also not may not be able to enjoy the low interest rate environment. So the debt maturity profile is important, and also the fixed rate interest rate is important. Okay, using the bubble chart here, actually you can do some screening on what are the REIT have a better opportunity to really optimize their lower interest cost moving forward. Okay, and this is a snapshot of what are the REITs currently they are trading the 5 years low. Okay, actually there are quite a number of REITs. They are trading a 5-year book value below the book value 5 years. Okay, you can see the CapitaLand China Trust, Mapletree Pan Asia Commercial Trust, Mapletree Logistic Trust. Surprisingly, right, these are owned by CapitaLand and also Mapletree or Temasek Link REIT. Okay, IREIT Global, Capital Pacific, Manulife, ARA, Hospitality Trust. They are trading 5 years low. But they are trading a 5 years low. Actually, there are also reason. You can see a lot of red color here, right? Because the gearing ratio is pretty high. That's why the investor, quite a number of investors, to minimize the risk, that's why they sell off, right? But when the interest rate start to turn coming down, the gearing ratio you probably tends to improve. Then it's expected actually the valuation will start to go out again and the share price start to move out again. Okay, but in general, it's quite healthy because majority of the REIT here still enjoy very high occupancy. Because at the end of the day, this REIT is a landlord business. As long as you are able to rent it out to your tenant, you are able to collect a rental, it is okay basically because they are able to pay the dividend. They have enough cash to really pay down their interest expense on and also all the working capital. They should be okay. Okay, and if I rank by the market cap itself, all right, we just want to focus on the REIT, which has a very big market capitalization. Maybe relative they are safer lah. So there are quite a number of them. The biggest market cap REIT is the CICD, CapitaLand Integrated Commercial Trust, followed by CapitaLand Ascenders REIT, and third Mapletree Logistic Trust, Mapletree Pan Asia Commercial REIT, right? That's why you can see that actually their past 12 months yield is pretty decent, 5.2%, 5.6%, 6.7%, 6.8%. So in general, by purely focusing on a big cap REIT itself, it's quite easily for you to get anything between 5 to 7%. Okay, in terms of dividend yield, and at the same time, the valuation is not so rich. It's not expensive, and occupancy rate is also quite high, more than 90%. And the interest cost, they are manageable, right? And the interest cover ratio, they are also quite pretty healthy. Okay, so combining all the financial ratio, you should be able to pick up some of the very solid REIT for you to hold in over the long term, especially the current valuation is pretty low. Okay, so if you want to know where to get all the information, okay, basically all the information here can be it is available on my website, okay, REIT Savvy, right? This is the QR code if you want to go and do find those charts. Now I move on to the Singapore REIT second half market outlook. So based on all the information I have presented, what would be the outlook in the second quarter, second half? Okay, in general, REIT index is currently trading at a huge discount. Okay, I will navigate through this chart again. The valuation here, price to book here, 1.1 is before COVID, just before the COVID. During the COVID crash, after the share price dropped by 40%, the PNAV is come close to 0.8, right? Then after that, we have a V-shaped rebound, and the S-REIT sector trading at the PNAV of 1.1, one time. Okay, then after that, for the past few years, past 1 or 2 years, when the interest rate started goes up, the REIT index continue to come down slowly. And at the present moment, the PNAV for the S-REIT index in average for 38 REITs is 0.77. Okay, so what does it mean? This, which means that at the present moment, the PNAV is even lower than the COVID time. Then now go back to common sense. During the COVID time, the whole world is at store, right? The we are not going to the office. Retail mall also shutting down, except the essential services, and the hotel, hospitality sector, they are beaten down very badly, right? So during that time, of course, a lot of fear. They are not able to. A lot of investors worry about the REIT may not be able to generate have collected enough rental income to pay a dividend to the shareholder. All right. But at the present moment, do you think that actually the current valuation is as bad as during that time in terms of economy? Definitely, economy now is much more better compared to the COVID time. So if you purely look at the number itself, at the present moment, the valuation does not really make sense. Okay, it's not as bad as what we think. The only one reason to explain is why the share price coming down is purely caused by interest rate and also the 10-year US government bond yield, right? So when the REIT index is trading at a huge discount, if even interest rates start to go come down again, you can look at the past history, what you can imagine what would be the upside potential, okay, when things turn. If everything just go back to normal, okay, maybe just price to book equals to 1, PNAV equals to 1. This represents 23% discount to the current REIT index. Okay. So in short, okay, this is a very important chart. In short, if the market does recover and after the cutting interest rate, there would be potential 20% upside. Okay, because if based on the historical average, eventually they have to go back to the historical average. Okay, more than 20% upside at maybe 1.1 PNAV, and at the present moment, the dividend yield is at 6.6%. Okay, assuming the REIT index now, they are not going back to the normal 1.1 okay, PNAV, right? Assuming they are just moving sideways, right? Moving sideways, doing nothing. You just imagine if you have a long-term view of holding a REIT and just collect a dividend, if you hold 10 years, okay, 6.6% multiplied by 10, all right, you already more or less get back at least half of your capital, okay, while waiting for your upside to come. Okay, so in short, at the present moment, is pretty attractive based on valuation. Okay, based on valuation, right? But of course, things may change because now everybody is anticipating the interest rate to comes down. But if due to whatever reason, suddenly the US Federal Reserve jam brake, they say that, okay, no, because of some of the data, inflation data coming back, we cannot uh, cut the interest rate. We have to increase the interest rate. Okay, whatever thing I present here, you can throw out window. Okay, no longer valid. All right, because if they continue to increase the interest rate, all the analysis here is no longer valid. Okay, do take note of that. It may happen, all right, but you have to look at the probability. Okay, and based on chart itself, technical analysis, okay, I draw many layers of support resistance. Okay, at the present moment, the REIT index is actually testing the resistance. Okay, this is the support turn resistance. Okay, after the rebound from the bottom. Okay, this bottom actually is close to the previous COVID crash bottom. Now, now let's see that whether the REIT index able to stay above this resistance, and this resistance become a support. Because when that thing happen, it may form a higher high and higher low, that kind of trend reversal pattern. Okay, this kind of pattern, high, low, high. Okay, then you can see there will be a reversal. Okay, but if you look at everything on the picture itself, look at the chart, look at the valuation itself, at the present moment, current level is pretty low lah. It's pretty low. When you buy, read, or invest in something, when the share price is low, and also when there's a chip, your downside risk actually is quite limited. Okay. But compared to your upside potential will be very huge, because whenever you do an investment, you always look at upside potential divide by your downside risk, and to see whether the ratio makes sense or not. Okay, if you find the ratio makes sense, then after that you just invest. Okay, and and I also look at US REIT to make sure that actually there's a rotation back to the REIT sector itself. So US REIT, I'm looking at the US REIT ETF. Okay, so this is a US REIT ETF, Vanguard Real Estate Income Index Fund. This is a REIT ETF in US. So after consolidated in a symmetrical triangle for many months, now recently, they just have a breakout. Okay, now breakout, and if this breakout is successful, it's expected to form the higher high, higher low, the uptrend pattern. Okay, so and based on valuation itself, again, valuation support this thesis. Valuation is cheap. Based on chart, also support it, and based on the future interest rate movement, the also support this breakout. Okay, let's see. This is based on my current analysis. Okay, let's look back at previous history on what would be the REIT sector performance under the rate cut environment. I pull up the 20 years chart US interest rate, and you can see from here that in 2021 to 2024, actually it's a rate cut cycle. Okay, the rate is coming down after they go up again. And after 2008, the interest rate also coming down and stay low for a while before it rise again. In 2020 to 2021, also under the low interest rate environment. Okay, so let's see what happened to REIT sector during all this rate cut cycle. So this is the sector performance. You have a different sector, for example, REIT sector, international stocks, small cap, big cap, large cap, diversified portfolio, global bonds, commodity, large cap growth. There are many sector and also asset class here. All right. So I box it out. These are under the rate cut environment. Okay, you can see that what would be the REIT performance over here in 2004. REIT actually was one of the best performing sector. Okay, went up by 30%. Then subsequent year, 2005, 8%, 2006, 30%. All right. When the interest rate start to peak, then of course they perform very badly. Okay. When there's a rate cut come again, after that, they also one of the top few asset class perform very well. Okay. So if you look at in general, under the low interest rate environment or rate cut environment, REIT you tends to outperform. Okay. Over the long term annualized return, okay, the REIT also giving us a total return of 7.73%. Okay, total return means that beside the share price itself, you add on a dividend 7.73%, okay, which is quite decent. So investing in REIT, you need to have a long time horizon. So key takeaway. Okay, this is a summary page on the second half 2024 outlook. So interest rate has probably peaked and US Federal Reserve start cutting interest rate in Q3 2024. Okay, that will actually give us a bullish view on the rate. Okay, and boost in DPU due to reduction in interest expense, like what I said just now. Cut in interest rate may not have an immediate impact on the interest expense. So for the next 1 or 2 quarter, basically, it's really much depends on the debt profile of the REIT itself and how the REIT manager they are really capture the rate opportunity. Okay, and the rotation may go back to the U asset class. The reason why, because the money market fund, the T-bill, and also and also government bond yield, you start to drop. When it start to drop, the fund manager itself, they will move out from a money market, they move out from a cash, then they look for some of the U asset class to invest to generate the higher return. Okay, so that is a bullish case. And current Singapore REIT are trading at a huge discount. So it's a bullish view. And REIT sector historically outperform other asset class under the rate cut environment. This is a bullish view. Okay, and this is a time for opportunity for the investor to lock in a higher at a discounted cash share price. All right. And lastly, on the technical chart itself, there is still no clear pattern that there is a confirmed uptrend on the REIT sector. So basically, it's neutral. We just need to wait for the uptrend to be formed to really confirm the S-rate you enter into bull market. All right. So this is the key takeaway on the S-rate second half of the year. Okay, but do take notes that whenever you plan your portfolio, you always need to focus on objective in mind. Okay, you don't wake up one day after that you throw all your investment, all your cash into the REIT sector itself. All right. So first thing first, in order to invest it properly, set your objective right. Okay, I use the retirement planning as an objective. All right. So if you are planning for retirement, it's better for you to have a proper diversified portfolio. The diversified portfolio is not 100% REIT, because I saw some of people, some of the retiree, they just throw everything 100% on REIT. And when the sector, when the interest goes up, basically the whole REIT portfolio, his or her retirement portfolio, basically everything is in rate, and suffer paper losses. All right. So I have to plan it properly. In general, level one is the risk-free that kind of income. Okay, so retirees should focus on the CPF life to build out the first level of safety. Then if they have some additional money, they don't mind about the fixed income or lower return, they can use a second level of private annuity to supplement the income. Once they build out this strong foundation, then the level three, they can have REIT portfolio, stock portfolio, or bonds portfolio to hedge the inflation, right? So REIT is only one of the asset class, okay, for investor to have. You don't put 100% into REITs, okay? Need to make sure it's diversified, okay? And the risk, return, and also liquidity of a different asset class, they are totally different. Okay, of course, whatever thing you have built out your passive income portfolio, you need to make sure you implement proper risk management strategy to protect your whole portfolio. Okay, and just like I mentioned, REIT is just one of the asset class when you build your investment portfolio, because there are many type of investment out there. Some of them lower risk, of course, offer you a lower return. Some of them very high risk, you offer you very high return. So REIT basically is in between, right? Because REIT has a characteristic of equity and also bond. Equity, that means that they also offer the upside potential. At the same time, they also give you a very consistent that kind of passive income, right? Bond, you give you coupon, REIT, you give you dividend. Okay, and there are many ways to invest in REITs. Okay, for example, you have managed account, you have REITs, you ETF, you unit trust, you can use your cash, you can use your SRS, you can use a CPF OA to really invest in the REIT portfolio itself. Okay, so it's important to design a diversified portfolio at the higher level first, okay, before you jump straight into the REITs. Because just like what I say, REIT is just one of the asset class in your portfolio. All right. And it's very much depends on your risk profile. You have to set a maximum allocation to a certain sector. All right. Because nobody can predict what will be the direction of the market itself. And if you're investing in REIT, basically your risk would be the single country risk, because you're investing everything in Singapore, in a Singapore REITs. And you also have a single sector risk, which is in the real estate. Okay. So you have to manage this risk properly. All right. That's the reason you need to have different type of asset class. You have a dividend stocks from all around the world. You have fixed income, bonds all around the world. You also have a multi-asset account income. And also you can diversify into some of the alternative investment. In this case, the alternate investment are currently available in the market itself. They can even offer up to 10% per annum, which is much higher than the Singapore rate. But alternate investment have some different type of risk element that investor need to be aware of, right? So it's important for you to build a diversified portfolio. And all these numbers are more or less real, is close. So building a diversified portfolio is to manage your risk. Okay. So all in all, if you're able to diversify properly, 6% per annum, that kind of dividend is totally not an issue. You just imagine if you're 1 mil, right? 1 mil, 6% per annum, you have 60,000, close to 60,000 dividend. Divide by 12, you have a $5,000 dividend per month. Okay. So it's achievable and also is doable, while at the same time reduce our risk. So this is the good time to start building your S-REIT portfolio. After you decide how much allocation to the REIT itself, you also need to further diversify. You don't go and buy one or two REIT and after just close your eye. Okay, that does not work in this way. It's better for you to select a REIT from different sector. You have a retail sector, office sector, industrial sector, hospitality sector, healthcare sector. Maybe just select 2 or 3 per sector and further diversify it, right? And at the present moment, based on the sector yield and also allocation itself, I just distribute you equally like 20% each, right? 6% is also achievable. Okay. And there are also other ways to invest in REIT. Once you decided to invest in REIT, allocate maybe 30% of your all investment investor capital to REIT itself. You can go ahead to customize a REIT portfolio. Okay, there are 38 for you to choose. If you find that it's too difficult to choose, too much work to do not know how to analyze the REIT, do not understand all the financial ratio, another easiest way for you to invest in REIT is the ETF. Okay, there are 5 REIT ETF listed on Singapore Exchange for you to choose. Okay, but of course, some of them are invested in other country, for example, Japan, Australia, Hong Kong, Malaysia, so on and so forth. So you have to read in detail which country you are investing in. Okay. The other way, you also can invest. Can use can hire a fund manager to help you to build your REIT portfolio. Okay. There are currently, what I know, there are 4 managed account available in Singapore from different broker. Okay, so C-REIT means that accumulative, whatever dividend received, you can reinvest. Okay, the fund manager or the asset manager, you help you to reinvest, or they can help you to have a payout REIT. And if you are Muslim, you want to focus on a REIT which is Sharia compliance, there also Islamic REIT available. Okay, for unit trust, there are 3 unit trusts which have exposure to the S-REIT. Okay, so get started to capture the market opportunity, because if the current market offer you a very discounted that kind of valuation share price to buy, and you don't want to use the opportunity to buy now, when do you want to buy? You want to wait for the whole market to go up first before you buy, then that will be too late. And by the time probably the share price has already gone out, they don't offer you a lot of discount. At the same time, the dividend will start to come down. Okay, so do it yourself or you get a professional help. All right, if you want to get started. So if you want to follow me, this is my Telegram channel, right? I every now and then, if I have any REIT news, analysis, or seminar, webinar, I will post it there, right? And sometimes I have an interview with a REIT manager, or I visit some of the REIT property. Okay, I will also post it there. And for last month, actually, I visited a few property in near in Amsterdam, under the Cromwell European REIT. Okay, and last year actually I visited Elite UK REIT in UK also. So this is my Telegram channel. All right. So the next one here is, if you want to contact me, you find that you like REIT a lot, you don't want to miss out opportunity, but you do not know where to start. Okay, so you can book an appointment with me, and I offer this kind of services. All right, REIT advisory, REIT portfolio management, retirement planning, investment planning. If you find that you're buying a lot of insurance, you do not know which insurance you need to keep, or you underpay, you overpay your insurance premium, or you are underinsured, I also can help you to do the insurance portfolio audit. Okay, of course, I also can do the estate and legacy planning and business succession planning. So this is my email, right? And this is my official website. Don't go and sign up the scam. This is my official one, all right? Whatever posted out there, it may be scam. And this is my official calendar. You can book the appointment with me. All right. So that's all for today update. Okay, I will read at the question if you have. Try to answer as many as possible. Hey, Elvin, where's the question? Or Q&A?
Yeah, under Q&A.
Okay, the slide will not be sent out, but you can this webinar actually is recorded. It's on the YouTube, right, Elvin?
Yeah, it will go live
So yeah, just
on
go
our
to the
Investing
YouTube.
Note channel. Yeah.
Yeah, Investing Note channel. So do not need to worry. Basically, you can see everything there already. Okay. What are the risks have low cost of debt? Wow, you go to a screener, you can find all the information already. So in a screener, right? I need to go and search for it. Okay, what's my view on the OUE rate base? Okay, I will not comment any individual REIT because this is considered a financial advice already. So I will not comment anything on any individual REITs. All right. So, but if you understand all the financial ratio itself, looking at financial ratio and listen to the fund manager interview itself, more or less you have some insight how the REIT is doing. So next week, next Wednesday, I okay, we have a recorded video together the REIT, OUE REIT CEO. So it's a collaboration video between REITs and also SGX. I was one of the co-hosts. So look up for next week the video interview so that you have much more information on OUE REIT. All right. So if you join my Telegram channel, definitely I'll post the recorded video over there. Okay, so Victor asked, many REITs have already locked in their loans on the long-term basis. Do you consider in your evaluation recommending as lagging as many years ahead? It can be lagging. Okay, it's also very much depends on whether the REIT manager they are able to break their loan or not. Okay, if they are able to break their loan and also the cost of breaking the loan is not so high, then they may do some refinancing and take out the opportunity in the when the interest rates start to cut. Okay, yield spread basically is the difference between the yield of the rate compared to the risk-free rate. Okay, for example, in Singapore, we use 10 years government bond yield as a risk-free rate. In US, we use a US 10 years government bond yield as a risk-free rate. Okay, when you talk about risk-free, they always refer to the 10 years bond yield. Okay, now layman, if the bond yield offer you the risk-free or maybe 3.5%, let's say 3.5% risk, okay, which means that the government can guarantee the 3.5% once you invested in, the government will not go bankrupt. Now, if the REIT itself only give you 4%, okay, the REIT you buy give you 4% yield. 4% yield, you have a risk because REIT can go bankrupt, right? In order to enjoy the 4% dividend, you have risking your investment to bankrupt if something happened to a REIT. So 4% versus 3.5%, that is a yield spread of 0.5%. Then the question for the investor to ask yourself is 0.5% yield spread good enough for you to invest in REIT or not? So the wider the yield spread, the more attractive the investment in short. Okay. On another words, risk yield spread can also consider as a risk premium. how much premium you have to pay, or they get rewarded in order to take that kind of risk. Okay, that is a yield spread. So for the fund manager or institutional investor, they will use a yield spread to make the investment decision. Okay, sorry, I will skip all those questions on specific REIT. Okay, so I'm not allowed to comment because I'm licensed, right? Anyway, MAS don't allow us to really make any recommendation, or SGX don't allow us to make any recommendation on any single REIT publicly. Do the REIT ETF or unit trust offer tax transparency? Okay, basically the REIT itself, as an investor, you do not need to pay the capital gain tax and also the dividend tax. Okay, so in short answer, yes. Okay, which REIT sector give the highest dividend yield? Dividend yield is lagging, right? So if you look at TTM of course, is the commercial office, right? But it means nothing, totally means nothing, right? The reason being is because the share price plunge a lot. When the share price plunge a lot already, your yield spike, okay? But it means nothing. Okay, Keith asks, is it correct to say that the REIT with more unsecured debt will benefit more with expected reduced interest rate? It depends. All right. So normally, for example, when you buy our residential property, our own home, those are secured debt. That means that whatever money, whatever home we buy, we pledge our property to the bank. Okay. So normally in general, when you pledge our property into bank, you enjoy lower interest rate. Okay, because it's all about risk. If you have unsecured, that means not pledge, you have a higher interest rate. But for the REIT itself, there are a lot more elements, all right? Because it depends on the credit rating and depends on the gearing ratio. Because all when the bank loan it, like they'll look at all this kind of ratio to determine how much interest rate to charge the REIT manager itself. Because it's all talking about all the risks. Okay, we will be still optimistic on the retail REITs after the RTS link start operation. Nobody can predict lah. So I just quote one simple example. I believe that most of you still can remember many years ago, when people talk about when e-commerce come up, right? You kill all the retail mall in Singapore. Okay, go back and read the article. Right? What happened to Singapore now? All the Singapore retail mall now. Okay, they convert to the big mega food court or a childcare center. So e-commerce have an impact, but they always find so-called reuse, refurbish or renew the usage of the REIT itself. Because at the end of the day, this is a property investment. As long as there are some usage of the property, and as long as there's a human, there are traffic, and some people willing to pay for using the property itself, they still can survive. Whether you want to sell things or be it taekwondo center or children childcare center or food court, it can convert. So I'm not so worried on all those things, because at the end of the day, they'll find a way to survive and also change your use. Okay, I can't comment. Okay, many of you tends to read the news, read the news, then after that make your investment decision. Okay, after so many years of investing, monitoring the market, my suggestion is don't waste time. Anyway, you can't predict. You can't predict, because in the stock market itself, it does not mean that good news is good news, bad news is bad news. Sometimes good news is bad news. Good news is bad for stock market. Bad news is good for stock market. Okay, very simple example. When the US economy doing well, right? Doing well. When all the economic data is doing very well, say that US is doing well, do you think the stock market will go out or come down? Okay, sometimes you just look at the reaction. When the economy is doing very well, okay, then the thought is inflation's coming in, the US government is going to increase interest rate. Once you increase the interest rate, okay, REIT sector you plunge. All right. So don't bother too much. And my advice is focus on the objective and also focus on valuation. Once you set up your objective clearly, once you reach the price level you want, and you have a very long investing horizon, just buy and just collect dividend. Focus on objective. Yes, NAV is lagging. NAV is definitely lagging, right? It can lag up to 1 year. Cap rate is the some sort of interest rate, okay, used in the property valuation. They use it different name. Okay, for example, for REIT, we call our dividend called DPU, distribution per unit. But for stock, we call it dividend. All right, dividend. For bond, we call it coupon. But at the end of the day, for retail investor, the layman term is passive income. So when you talk about cap rate, then for professional, immediately they know that it's talking about property valuation. So different sector, different so-called professional, they use different terminology to talk about interest rate. Which type of REIT are best to look at now? Basically, the whole REIT sector is attractive. Once you do a homework, you know how to read the financial ratio, you can find a lot of opportunity every sector. REIT sector pay dividend, yes. Sorry, REIT ETF pay dividend, yes. The answer is yes. REIT ETF pay dividend. So what is the allocation of growth stock for a retiree? Depends on the risk profile. In general, if you have already built up your passive income, you don't need to rely on the growth stock for the passive income. You are able to take risk, you can allocate. All right. But if you have not built up a passive income, or you do not have any sufficient passive income, not advisable, you go for a growth stock or technology stock. It is too risky, because if something happened to the stock you own itself, you don't have time to really recover, because you need that money for your retirement. Especially during retirement, you need a lot of liquidity for any unexpected event to happen. Okay, what are the main difference between the S-REIT and also US REIT? Okay, there are few. First thing is the gearing ratio. Singapore REIT gearing ratio is 50%, right? US no have gearing ratio. Okay, in other words, the US REIT, they can borrow a lot of money, go and grow their portfolio. But on another hand, they are much more risky, right? Because you have unlimited, you can borrow whatever thing you want, right? If they are not able to service that debt, they can go bankrupt easily. The risk management for S-REIT is safer to protect investor. First thing. Second thing is S-REIT, we don't have any capital gain tax. We don't have any dividend tax. So US REIT, you have a withholding tax 30%. Right. So you using the US REIT to go collect dividend does not really make sense. Why do you need to pay 30% to IRS? Right. Those are your money, right? Doesn't make sense. The third one is estate duty. If investor invest in the US stock market, if something happened to you, your beneficiary have to pay up to 40% estate duty before you can inherit the thing. The question here, just imagine if you have 1 mil US stocks, all right, then die at the wrong time. There you have your beneficiary, your executor have to pay 400,000 tax to IRS before you can inherit the 1 mil. Okay, but throughout the probate, throughout the administration, maybe you take 1 or 2 years to get back your investment, your US stocks. But during that time, market crash. Okay, market crash, maybe your 1 million portfolio become 300,000. Okay, then you pay 400,000, you get back 300,000 for what? Okay, basically a lot of people invest in US stock, they think that this thing will not happen, but estate duty is a big issue. Very, very big issue, because you lose money and you sabotage your beneficiary and also executor if you don't manage it properly. Okay, how about the office REIT impact by a new working and arrangement, flexible working? Okay, just think of it. You have probably stay at home, work from home, and also go to office, right? Do you think that human can forever just staying ourselves and basically 100% work from home? I don't think so, because human is a social animal, right? First thing, we need social. We need to interact with other people, right? Instead of just working alone. All right, that's first thing. Second thing is the bosses. No bosses want to pay a salary to an employee and cannot see the employee and also do not know what the employer are doing. Right. So short term wise, you have impact, but over the long term, I strongly believe everything you back to normal. Right. If they don't back to normal, the office itself, they will start to adjust accordingly. All right, maybe have a working space, more co-working space, and maybe actually the REIT manager, what have done something there's installed some of the pantry or gym to encourage people go back to office to work, right, to mingle around, right, and also F&B. So eventually the commercial office issue in US, I think that they'll normalize eventually. It take some time only. Okay, Singapore versus Hong Kong REIT. Okay, so in general, okay, Hong Kong, there are not so many REIT compared to Singapore. So Hong Kong, mainly you'll be more on the retail and commercial office. And of course, the regulation, you just need to take note that the regulation and also currency using the Hong Kong rate. But first thing first, go back to objective. If you want to have a reliable passive income, you do not want to have so much risk, especially forex risk and also government risk. Why do you need to look for overseas? Because Singapore base that kind of risk is sufficient to meet the objective already. All right. So focus on objectives is important and focus on the risk management, right? Risk management. If you are holding the stocks in overseas stocks, if one day, if you can remember the clock shares with Malaysia last time, right? What happened? That those are the things we can happen because other country that impose certain thing on other foreign investor, those things we cannot control. So if you're holding many overseas REITs or stocks are not necessarily Hong Kong, you are exposed to that kind of regulation risk and also the country risk. Okay, US closed-end fund, if they are registered, if the fund manager is in Singapore, under the Singapore, then no estate duty. But if you're buying the US closed-end fund and listed on the US entity, then subject to estate duty. But for more accurate information, you probably have a text with a tax lawyer. Tax lawyer will give you a more accurate interpretation what is subject to estate duty, what is not subject to estate duty. If you invest in US stock with local fund house where you are nominee, you do have it. Okay, so it's still a similar thing. It depends on where the fund house local fund are assuming Singapore local fund house are then probably not subject to the inheritance tax. All right. So the Telegram code. Okay, I flash a Telegram. Okay, this is a Telegram QR code. Okay, any more questions? All right. So no more questions. How to get more information on the income fund for the AI. You can contact me separately. Right, because those are the alternate investment and I need to qualify you as an accredited investor before I can give you those information. All right, you can contact me. Okay, this is my email. Right, just contact me if you need more information. All right. So Edwin, I hand over back to you.
Okay, hi. Thank you, Kenny,
Thank you.
for your very insightful webinar. For those of you who want to do follow Kenny on LinkedIn. You can also follow him on his Telegram channel. Yeah, so that you can get the latest updates for REITs. The website he was using for those data is also REIT Savvy, so you can also go to the website to take a look also. There's also a Fed meeting coming soon on July 30th, so also do keep a lookout for it. So if there's any positive news about interest rate, right, the share prices for REITs will also go up. So do keep a lookout. So some things I just would like to share before to dismiss is that for those of you who are subscribed to our Share Investor Web Pro, we also have a category here under the share prices. You can select Trust REITs. So basically it just filters out all the Singapore REITs for you. And under the column layout ratio, you can also take a look at the price, revenue, dividend payout for all the REITs here to look at the data. And also, we also do have a trading forum. It's called Investing Note. So this is where many investors all over Singapore will talk about the latest news on REITs. So this is a free sign up for our trading forum. So if you're interested in like the latest shares, latest news on REITs and everything, you can always sign up and take a look at our forum over here. Yeah. And also we also have an upcoming virtual event this Saturday. It's called SG Gems. For those of you who are interested in Singapore listed companies for small and mid cap, you can register for free. Basically, they talk about the latest analyst reports from all different brokerages like DBS and all that. And they will be doing a live. We have some live programs here where they talk about the latest half of the new strategies for the second half of 2024. So we have some economists like Chua Han Teng, Mr. Song Seng Woon. Yeah, some of you should know him. Yeah. So this is happening this Saturday. So it'll be from about 10 a.m. to 2 p.m. Yeah, this is so free. You can sign up if you're interested. You can sign up and come in to listen. Yeah. So this is the REIT Savvy website. So you guys are interested in all the REITs data and all that, right? You can come in over here to take a look. Yeah. So again, shout out to Kenny for agreeing to do this webinar with us again. For those of you who wish to watch the replay for our webinars, you can come to our channel on YouTube at Investing Note. Yeah. So we also did do some live webinars every month previously. So the last time we did for Kenny was about 4 months that we did a webinar. Over here, we also do have collaborations with other KOLs like the Joyful Investors and all that. So if you are interested in watching more webinars, you can come here to take a look. The replay will be out soon. Probably I'll be doing it. I'll be making it live, the replay live tomorrow. So do keep a lookout for it if you guys want to look through the data and the insights one more time. Yeah, and I think that's about it for today. I'd like to thank everyone for coming down to listen to us. Yeah. So if we do have any more future webinars and all, we'll be sending out EDMs and all that also. We do have Telegram channel for Share Investor and Investing Note. So I'll be posting the news and all that for the latest webinars and all that. So yeah, do keep a lookout. And thank you so much for everyone for coming down today. Yeah, if you have anything you guys want to you need the contact details for Kenny and everything, do contact us at admin@shareinvestor.com or admin@investingnote.com, and we'll do our best to help you. Yeah, so thank you so much today. Wish everyone a good day ahead and a happy weekend. Yeah, thank you.